It is my pleasure now to introduce our guest for today, Greg Harmon of Dragonfly Capital. Greg, before you get started, I do have one question for you because it is Fed Day, and I know you're going to talk a little bit about that. But, I've made the observation over the past 6 months or so that it seems to me that the Fed Chairman Powell has been a little slower to react to some of the financial markets than his predecessors. Just wondering if you had any comment. You seem to be slow to get rid of the rate increases back in December of last year, waited until after the market took a pretty big dive. And he's been pretty slow to come around to lower rates. Do you have any opinion there?
Well, I think that that's a good overriding statement and question to get this whole thing kicked off here. From the market's perspective, yes, he has been slow. Is that appropriate, though, is really the question. Mm-hmm. And if I can just jump right in then, I think that there's been a real short-termism that's been going on in the market. You talked earlier about changing character in a couple of stocks and a couple of sectors. And if we look back at from a longer perspective at how the markets have traded, how rates have been moving, we had the first change of character in the markets in December 2015 when the Fed first raised interest rates, and we started moving up from zero. And that continued until December last year. Now, December last year, what did we have? We have what many in the market thought was an inappropriate rate hike. But if you look at some of the evidence, you could certainly make a case that it was appropriate as well. We've got raging employment markets. We've got no inflation. But we had some spikes a little bit towards the end of last year. So is there a transition going on now from that rising rate environment to a falling rate environment? Well, just like some of my friends like to say, markets and stocks don't move up or down. They can move up and down, but they can also move sideways. And that's really what we've been in now. So the market is certainly telling us that it wants to move rates lower. And we're seeing that the Fed, from that perspective, is slower than what the market is looking at. When I was doing some research this morning, I saw that we had about 80% chance of a cut in Fed funds rate by the July meeting, priced into the Fed funds futures market. That's a pretty solid estimate, a pretty solid view that the Fed is going to cut rates from just a few months ago, in January, where we had Chairman Powell tell us that it was time to pause and to be patient. So can the Fed move that fast? Second question then is, does the Fed get ahead of the game? Has the Fed ever had a history of being ahead of the game, trying to cut rates before a recession hits, for example? We're trying to raise rates before inflation starts to rear its head. And if you look back in history, there's not really a good precedent for that. So what do we need to do with that? We'll get back to that stuff. Taylor Swift, I think, put it best. We need to calm down. Now, I didn't know she was going to write this song and do this when I was first asked if I could come on and talk about the markets, but it was really appropriate that it came out just this past week. We just need to calm down a bit. We don't need to have a Fed cut right now, even though the market's pricing it in. So with that backdrop, low inflation, strong employment, earnings still rising, but at a slower pace. The market is still pricing in an 80% chance of a cut by July. And what is the consensus today? The consensus today is that the Fed statement removes maybe one word from their policy statement that says that we're not going to be patient any longer. So how has the market been adjusting to that? If we look at the CRB Index, and every one of these charts I'm going to show you today is a monthly chart. So it's a very long-term view. The CRB Index has really been doing nothing, moving in a range for the last 3 years. What is it doing short term? Short term, it's been falling, and that's a good thing. That certainly bolsters the case that the market is presenting, that it's time for, or that it's appropriate, it's possible for us to have a rate cut. From a technical perspective, you see in that CRB index since this time last year, a series of lower highs and a series of lower lows that we're starting to head down towards now if we keep going. So inflation is in check. So maybe the Fed doesn't have to be as aggressive about controlling interest rates. And that's a good thing for those that are looking for a rate cut. When we look at some of the pieces underneath there, some of the markets that people follow, the copper market. This is showing the same kind of reactions that the inflation market has shown. We've got the top there in 2011 and a series of lower highs. Solid bounce in 2016, but from the retest of that rising trend line in 2017, the copper market has been weak to flat, hovering right around its 200-month moving average. What does that tell you? There's not really pressure on things like maybe the housing market or the building market, where a lot of copper is being used. If we look at crude oil, the crude oil had a strong run up from 2016 when the Fed started tightening rates, and looks to have stopped just before they started to back away. But that's also a lower high in crude. The rebound back down to support just over $40, around $45 at the start of 2019, shows us that we've got another lower high in there. And what's most important to me here, a failure to break above this 200-month moving average. So long term, not so strong. You'll see that I use RSI and MACD are really the main two indicators that I use on my charts, and it's showing the same thing there. A lower high in the RSI and barely breaking above the 50 level. So oil is in check. Oil has been the past 4 or 5 months having a fairly strong correlation with the stock market. What else is going on around the world? Well, you've got other stock markets. You've got the Tokyo Nikkei average hovering at highs, at multi-year highs, at 20-year highs. Pulling back slightly, but still more of a consolidation than a reversal. So strong growth in the equity markets continuing, with maybe a little bit of retrenching in the world market. But is it just Tokyo? The German market is maybe a little bit weaker. We saw it top out in 2017 and pull back. But over the last 6 months, it's been strong and now consolidating. Is it waiting for Draghi to cut rates, or is it waiting for Powell to tell us what he's going to do? It's certainly not rocketing one way or the other. Then one of my favorites, the Chinese market, the Shanghai Composite, has gone through, had that massive pullback in 2009, 2008, barely recovered from that to then come back up to a top in 2015, but it's been making a series of lower highs and lower lows since. A rough market. China has been having a really hard time, and is that going to be a big impact on what happens to U.S. policy? All these things at some levels are interlocked. So if we move beyond world markets, then and look at something like gold. What is gold telling us about the state of world markets? Well, when I look at this chart, the pullback I see there, a 50% pullback of the move higher from 2000 to the top in 2011, and then virtually no bounce. Just a solid flat line hovering right around that 38.2%, that key Fibonacci level, and been sitting there for 3 years. Is gold showing that the dollar is going to head one way or another, or is gold showing that inflation is moving one way or the other? It's really telling you that we're in kind of like this Goldilocks environment where nothing's happening. No strength and momentum. It's failing to get above 60 on the RSI, and you see the MACD is hovering right around close to 0. What about the dollar index? I've seen that the dollar index tends to move in 7-year cycles. We had from 2002 down to, or late 2001 down to early 2008 as a major downtrend. And then 2008 through to 2014 as a kind of a sideways move. We had been in this upward trend, and then all of a sudden it stalled out at the end of 2016. Well, what happened at the end of 2016? Well, we had an election, if you might remember, and the whole world changed at that point from an expectations perspective. But if you take that 1 year out, 2017 to 2018, the dollar has been strengthening since then. But where is the dollar right now? It's just hovering right around this 97 level. Longer term, it's been between 90 and 100 for 5 years now. Not a whole lot of change for a discussion of are interest rates going to be moving higher, or interest rates going to be moving lower, or are they going to be moving sideways? What has been making a really clear statement, though, is Eurodollars. Eurodollars, you can see the start of the tightening cycle up here towards the end of 2015 as Eurodollar prices started moving in line with interest rates. And then that pause as the Fed slowed down into 2018. As we moved through 2018, then we had the surprise tightening in December that brought us to the bottom, and the Powell reversal. In January, came out and said, well, I'm not going to say I made a mistake, but we're not going to be tightening anymore. We're not going to be running off the balance sheet. We're not going to be doing quantitative tightening. This, I think, is the most interesting aspect of short-term rates. So despite Powell saying that we're going to pause, the market did a total reversal turn. And instead of saying pause means moving sideways, the market has said pause means we're going back the other way. So is it just the market being a forward discounting mechanism? It could be. We saw the same thing happen, though, in 30-year bonds. Here's just a 20-year price chart of 30-year bonds, but you could take that back another 10 years and you'd have that same rising channel. We had the little breach of it towards the end of last year, and it's kind of a false breakdown with bond prices moving back up now, and almost at the point now where they're retaking the 2017 highs. So bond prices, you think about bond prices, you think about risk-free rates plus inflation premiums, long-term and long-run inflation premiums. If inflation, as we said, is falling, that's certainly more of an indicator that bond prices, which are inverse to rates, so rates would be falling with bond prices rising. With inflation falling, it's questionable whether bond prices are rising and rates falling because of lowered inflation expectations or because of lowered interest rate expectations from the risk-free rate. But it does fit a case where lowered short-term rates do fall into play. What does all this mean? All this means to me that this chart of the S&P 500 that's been my guide for the last 10 years is continuing to play out. And yeah, I'm not a huge Elliott wave guy, but some of the aspects of Elliott wave have played out very well here since the 2009 low, with what I counted as a 5-wave move within the third wave that ended at the beginning of 2018, and a correction that ended wave 4 of that at the end of 2018. So by my count, I see that the 5th wave of the positive factors here has possibly phased out of the first run of that wave. So I marked a 1 on there at the end of April. The question is, have we flipped the switch now, and can we draw a 2 down here? And that's what everyone's playing for today, right? We've got the Fed now. All of this leading up to the Fed is expected, according to market expectations, to do something to indicate that they are ready to lower rates in the short run. So sometime in the next 6 weeks. With that, stock prices have been moving higher in June. Bond prices have been moving higher in June. And gold has been moving higher in June. Can it all go up and continue to go up? One last chart I wanted to show you is, because I know the Elliott wave can get pretty complicated and lots of people can interpret it a lot of different ways. One chart that makes it a whole lot easier to interpret what's going on in the world, at least in the stock world, is to look at a Renko chart. I like to think of Renko charts as a combination of a point and figure chart and a candlestick chart. So point and figure from the perspective that we don't print another box, or brick as they're called, until the price of the index or whatever we're measuring moves outside of the box size. And the box size here on this chart is the average true range over a 14-day basis. So for me, it's here 29.95 S&P 500 points. So just under 30 S&P 500 points. So as of the close yesterday, Renko charts were telling you that the S&P 500 is still a buy. So how do you position for this now? You've got expectations that the Fed is going to change language so that they can cut rates. I don't think that there's a whole lot of faith that the Fed will cut rates in this current meeting, but the expectation is that they will open the door so that they can do it in July. Back away, though, to December, when the expectation was that there was going to be no rate hike, and Chairman Powell still managed to shake the market by calling for and actually raising rates. So we've got real examples of the Fed moving separately and diverging from what market expectations are. Different interpretations of what the economy actually looks like. You know, we still have the Federal Reserve bank offices, the regional banks, coming up with GDP estimates around 2%. So this is not recessionary. There's not really a need from that perspective to cut rates unless you think that you need to get ahead of that perspective. And with all that, the market has priced in higher stock prices, higher bond prices. So the market has certainly been pricing in, from a bond market perspective, rate cuts for a long time. And now it seems that the stock market is starting to price that in as well, as earnings are slowing a bit. So what do we do with that? Well, clearly you have to be long, positioned long in this marketplace. But but you need to have some protection for that aspect that Chairman Powell goes against what's happening in the broad market in terms of expectations, again, at this meeting. So how do you do that? Well, from my perspective, I'm an options guy. I think you noted in the beginning that I wrote a book called Trading Options, where I use technical analysis to do this. For me, it's a matter of looking at what the potential moves are in the stock market and buying puts or buying put spreads to participate in the downside if there is a pullback because the chairman disappoints, but managing to stay long as well. So I guess to sum up my perspective here, we've been in a long-term tightening cycle that clearly ended in December when the chairman tightened rates and then backed away from a promise to raise rates again. We've got a market that's taken the interpretation of that to say that the tightening cycle has ended and now we're going to be into an easing cycle. But no firm commitment from the chairman that they are doing anything other than just waiting and seeing. So the typical data-dependent view. So you would expect then that anything that goes away from the ability to allow the Fed to ease in July would be a disappointment to the market as it's kind of run past the flat line perspective and move to the easing perspective. So I would suggest that if in the next hour and 15 minutes, if you have not done something to either hedge some profits or put some protection in place, that you've still got an hour or so to do it. And that's what we've done for our clients and our portfolios as well.
Very good, Greg. I got a couple questions for you. I know, well, at least based on what you were just showing on your charts there, especially with that Elliott wave, looking at another big move potentially in the markets, is that helping to drive your portfolio management, believing that the overall direction in the U.S. equities continues to be higher? And if so, what are you positioning in, not just ahead of the Fed? I mean, that's a short-term thing, but more long-term. Are you looking at relative strength to help you in various sectors? How do you take this information that you just presented to us today, and how do you then go to the next step and say, okay, this is what I would be interested in owning going forward?
Yeah, so from here, I take two steps. I look at this as the first view to determine which way the trend is. And as I guess I made clear, from my perspective, the trend remains to the upside. With that information, then, I have a universe of about 1,000 stocks that I break down not into straight sectors according to the classifications, but sectors like commodity, industrial, machine-driven sector, financials, pharma and healthcare, tech, and then I lump a whole lot of other stuff into retail. And I'm looking for, which one of these is actually performing the best. And I look at every one of those charts, every one of those 1,000 charts, at least once a week to determine what's going on. And I'm an old school guy. I've been doing this for 30 years. So I'm handwriting these names in a notebook. And for me, then it's real easy. I see that when I look at the 1,000 charts, if there's 60 that look good in the finance sector, then that's where I'm going to focus. If there's only 10 in tech or 5 in healthcare. Lately, probably to no one's surprise, tech has been the hot spot. And over the last month or so, healthcare has been turning around and showing up a lot more often as well. I'm looking at those stocks from a from a technical perspective. So I presented some stuff here that looks at Elliott wave, but I use classical patterns and I use Fibonacci analysis, and I'm looking for a confluence of different types of technical analysis to drive multiple forms that are showing that a stock is ready to move. Mm-hmm. And then when we get into these uncertain periods, it's where I use the options information that I have to put an options overlay on top of that, so that instead of, say, buying MongoDB or C's, which has been the hot software sectors within tech, I might buy instead call options on those stocks that go out a couple of months to be able to ride the momentum waves as they move higher, but to limit the amount of capital I have at risk. Mm-hmm. So if you look at my portfolios, I'm about 80% cash right now. Yet my delta in my portfolios is over 1. So I'm outperforming the market with 20% money invested, because it's all been levered through options.
Do you have any options that you use to protect your portfolio in the event that we do have some kind of a market meltdown?
Absolutely. I'll tell you the most recent trade that I put on for clients was I put on some put butterflies 2 days ago. Should have done it yesterday after that big move yesterday, but I did it 2 days ago, where I'm protecting for a drop down in the S&P down below 2750. So if it moves down to 2750, I'll pick up some good protection to the downside. And if it moves below that, my protection starts to fade a bit. And that's very short-term protection for this statement today. Longer term, I've got S&P put spreads and what are called 1-by-2 put spreads, where I buy one put and sell two lower ones as longer-term protection through the end of July as well.
Is there any particular reason? I mean, it sounds like you're pretty bullish that you think the market's going to go higher, although you're trying to protect yourself to the downside. But is there any reason that you're only, that you've got 80% cash? I mean, granted, you've got the leverage there to kind of make up for some of that, but is there a reason why you wouldn't be more invested given your bullishness on the market potentially going higher?
Yeah, well, some of it is that the sector that's been leading the way has been tech. And now starting to see more healthcare as well. And those have tended to be playgrounds for momentum traders. So there's a lot of liquidity in both the stock and the options in those markets. And since neither one of those sectors hold a lot of stocks that pay dividends, there's really no reason to buy the stock. So this is not this capital gains treatment that you're looking for in terms of or dividend treatment that you're looking for from holding for long periods of time and collecting the 3%, 4% dividend, whatever it is for some of these stocks. When the dividends are really low, you can get just as much benefit from a move by holding the options with a lot less risk. Usually 3 to 5% of the price of the stock to buy the options. And if you're not going to give up a 4 or 5% dividend, then it's an easy thing for me to look at.
Before we wrap up, is there? I see your website there at the bottom of the screen, dragonflycap.com. Is that where folks should go if they want to learn more about what you do?
Yeah, dragonflycap.com. There's a page on there about that talks about more of this in detail, about how I get to these 25 to 35 trades a week. But dragonflycap.com is where you'd find this.
It was a great pleasure having you on here today, Greg, and we certainly look forward to having you back soon.
Thanks for having me. It was good fun today.
Yeah, a lot of fun.